Let's go ahead and get this thing started in 5 minutes. Hello to everybody out there watching on Zoom. Hi to everybody in the room. Thanks for coming. So this is our Winds of Change Economic Summit. We just wanted to get as many of our members together who wanted to learn about things that are going on and ways to mitigate it and ways to prepare yourself for what may be coming down the pipe. So we have brought Jeff, right?
Yes, correct.
Yeah. And Matt and Jorge and Michael. Am I right there? From Bead Industries is also going to talk a little about importing and other things that are happening there. So without further ado, Jeff.
Thank you so much. I appreciate it.
Yeah, Coastal Bridge.
Yes, yeah. So it's Jeff Kalipos, the Chief Investment Officer of Coastal Bridge Advisors. We have an office here in Milford, Connecticut, and we have one in Westport, North Carolina, and California. So we're really spread out across the country. So thank you for having me here today. Before I start, more of a compliance thing we have to say, this is not financial advice we're giving today, nor is anything discussed a trade recommendation. We recommend before doing anything, you contact a financial advisor before you move forward. So getting that out of the way, what I was asked to do is talk a little bit about the economy today and what's going on. And, the first word I can think of that I hear from our clients and that we hear from really anybody is uncertainty. And it's a common theme. I think we all feel it, including myself who does this for my job. So let's start by talking about the positives of what's going on in the economy right now. First, I'll say the labor markets actually look pretty good. People have jobs. The unemployment rate right now is currently 4.1%, which is really in line with a solid economy. So again, that's a positive. Initial jobless claims, non-farm payrolls. These are things that we look at, and they're all suggesting that we're in a great employment situation right now. Now to get to the stuff that's not so great. Consumer sentiment. Consumer sentiment is when people go out and they survey people and they say, hey, look, how likely are you to spend money to buy things? How likely are you to expand your business, maybe take a loan to grow your business? And those are pretty darn bad right now. We look at what's called the University of Michigan Sentiment Index, and it's at 50.8 right now, which, just kind of to put that in historical context, the only time it's really been worse on record was during COVID-19. So again, sentiment is not strong right now. And I think a lot of that has to do with the uncertainty of what's going on with our foreign relations, with tariffs. There's just a lot of things to talk about. Inflation, another thing that people are quite concerned about. And the good news that I see, at least, is that inflation is certainly heading lower, and it has been heading lower until more recently. There's been concern about it kind of sparking again and reigniting. Now, that's something that was brought upon through tariffs. And I'll talk a little bit about tariffs without making a political statement. But the current administration has gone out on Liberation Day and said, hey, we have these huge tariffs we're going to put on other countries. And really, they targeted countries where the United States had a very large trade imbalance. Again, the stock market and people that are invested thought those tariffs were coming, but they didn't think they were going to be as bad as they were announced. The consensus I've heard is people expected around 10%, and that number was almost doubled. In some cases, it was just astronomical. Now, the question becomes, and again, tariffs are really complex. There is a history of them happening. We did do some tariffs in the early 1900s, and they're said to have created inflation during that time. I believe firmly that tariffs will lead to inflation, more inflation. Now, I'll say that with a caveat. I don't know how much inflation it will lead to, or for how long. It could end up being a very short period of time. It could be an extended period of time. It really depends on a lot of things that we're, again, my theme, uncertain about. The question really is, what is the purpose of these tariffs that the president has put forth? Is it to create revenue for the United States, to bring in more money, to help pay some of our debt? Is that a reason? Or is it a negotiating tool? And that's something that we need to understand. If it's a negotiating tool and the United States is able to secure better trade deals with some of our biggest trading partners, then it could be a net positive, and it could have a different inflation expectation. If it's to drive revenue, it could have a different result. So again, we get different comments every day from different people within the administration. I think the uncertainty is a theme we're going to continue to see for some time. We are apparently in conversations again, at least what I'm seeing reported, with India, Japan, and South Korea, which are huge trade partners of the United States. Most of the automotives, when you think of Honda, Hyundai, Toyota, these are obviously Asian companies located in Japan and South Korea. So these are places that we really need to work on a plan ultimately, so that we can see those tariffs come down. The big concern, obviously, is companies are going to be paying more money for their materials to bring them over here to the United States. Whether they pass them down to consumers, I think that's the expectation. That would be inflationary. If they're able to absorb some of it, it would be a little less inflationary. So again, we're preparing for that. We're thinking about those things and what kind of reaction the markets will have. When you think about the next thing that in the economy, it's the US dollar and kind of what's going on there. And what you saw with the tariffs when they initially were put on is you saw the US dollar become devalued versus some of the biggest currencies out there, whether it's the euro or the Japanese yen. That's really important. Normally, in a time when tariffs are put on, the US dollar would have strengthened, and actually the opposite happened. And there's a lot of speculation as to what caused that, and is it going to continue to go down? What's going to happen there? And I've heard that question quite a bit. And there's a few things that would lead people to kind of, leave the dollar, if you will. It's, the fear of growth slowing down across the world, so more particularly in the United States. I think it's uncertainty around the tariffs. If these tariffs stay in place, what's going to happen with our trade partners? How's that going to look? How are we going to be trading with China if we have 140% tariff? How will that work? And there's obviously a major concern about the debt the United States has. We have an enormous amount of debt. Make no mistake about that. And it's really not looking to slow. It's looking to ramp up and have more debt put on the United States. Will we pass a budget? Again, I'm going to come back. There's a tremendous amount of uncertainty. And I think that that's part of the reason that the US dollar has devalued. Again, make no mistake about this. It's still the reserve currency of the world as of right now. And I think it will remain there until something else comes along that can sustain that kind of importance. That, when you think about being the reserve currency of the world, you have to have an enormous value, an enormous amount of liquidity. And right now, the US dollar is that. And at least for the time being, I just don't see that going away. Could it strengthen again? Absolutely. Could it get weaker? Definitely. But again, we're uncertain what's going to happen right now in the economy. I don't want that to be a warning for people, because I'm actually, quite positive on the markets. And I do think that they always do seem to find their way. And I do believe the US dollar will continue to be strong. But again, I don't want to make any promises, because we're in pretty uncertain political times. The stock market. I'm sure everyone's had a chance to look at their retirement money and their 401ks, and these are all things that I recommend you don't look at for the time being. And again, Matt's going to get into that in a minute. But what's going to happen? How will stocks react? Well, stocks and bonds really don't like uncertainty. They really, really don't. And when you think about some of these companies, a lot of people on this call are business owners. When you think of a retail company that creates clothing, most of their clothing is produced in China or Vietnam and these countries where major tariffs are coming. Now, there's a tariff on the table. It's currently 10%, but it could be 45% in 90 days, or it could be higher. You just don't know. So you have to make capital decisions. Should we be making more clothes? Should we hold off on this order? Should we speed the order up because maybe it's going to be cheaper now? So what you're seeing is companies are coming out saying, hey, we normally give you guidance as to what we're planning to do this year and what kind of earnings we're looking to have. But it's very difficult for us to do that because we don't know what this tariff situation will how shake out. So again, you're going to start to see companies come out and say, hey, we're not really sure where things are going to go from here, but we feel very confident in our product. But, we just are having difficulty spending money right now. We don't know if we're going to expand because we don't know if now is the right time. So I think, again, you're going to see a lot of uncertainty from companies. And with uncertainty, you tend to see these movements, crazy movements up and down in the market. We've seen those over the last 2 weeks. I mean, when there's been a hint of a deal being reached with the country, the markets have rallied like unbelievably. I mean, 2, 3, 4%, some of these companies. And then on days where things are not so great, you're seeing some of these large companies like Nvidia and Apple and all these big tech companies are getting clobbered. So again, it's a world we haven't lived in quite some time. I recall it back in 2008 when we dealt with this type of volatility. And we're going to continue to see it until we get a little bit more certainty in these markets. When that's coming, I can't assure you. We've got other things going on in the world with the Ukraine-Russian war, where we're trying to get peace agreements there, and it doesn't seem to be sticking. Certainly with the attack we saw on Ukraine 2 nights ago. You've got Israel is another hot topic. So there's a lot of things going on in the world. What you are seeing is people go to things that they feel comfortable with during uncertain times. One of them is gold. Gold has hit an all-time high. I mean, we're talking $3,500 an ounce, which is just a far cry from where it was a few years ago. And that's where you'll see people migrate to in these uncertain times. Hopefully, we get a better picture in the next few days, maybe the next few weeks, maybe the next few months. But as that develops, you're going to start to see more certainty about what the future looks like. I'll hand it over to Matt because I think he's got some good points on that as well.
Yeah, so I've been getting a lot of questions. How do I react to this? And if you react to every single headline, that's when you can get burned, because time in the market is far better than timing the market. Timing the market is possible to do. So before I answer these client questions, I'll ask them, have your goals changed? Has your financial situation changed? If the answer is no, you should stay the course. So now, while these investments are now trading at a discount, you have the opportunity to buy in for a much cheaper price. The market will recover. We can't tell you exactly when. You think about the financial crisis, 08, 09. Horrible time for everybody involved. But the timing was 08, 09. It wasn't 08 to 15. It recovers quickly. Same thing with the dot-com era, 2000, 2000, 2001. The markets will recover. So the advice should be stay the course, especially because even 2 weeks ago, there was a rumor that tariffs were going to be paused for 90 days. The market shot up 8.5% in 35 minutes. So if you were to sell everything, move to cash, you've now missed that upside. Same thing when Trump had mentioned that he wasn't going to fire Powell. The market reacted positively to that. So, these swings can happen overnight, essentially. So you don't want to try and time the market. The idea should be speak to your advisor. If you don't have one, reach out to us for advice. We'll certainly help you. But what you don't want to do is start constantly trading in and out of the market. That's the worst thing to do for portfolio.
Great if you're a commission broker.
Yeah, exactly. That's exactly right.
Yeah. And now Jorge, a little bit more.
Thank you. Jorge Santiago, President and CEO of the Milford Bank. So I am not a broker and I am nowhere near as positive. But that's just how bankers live. So just understand that that's the nature of being a banker. I have a lot of concerns, right? So as we look at financial data through the end of the first quarter, the Atlanta Fed, the Federal Reserve in Atlanta said, hey, we expect that the US economy is going to show a retraction in the first quarter, negative 2.8% growth. That's a problem, right? We were used to quarter after quarter growth. That's the first quarter of retraction. If it happens 2 quarters in a row, it's generally called a recession, okay? So that's a fact of what's happened. The leading economic indicators, which tell us kind of where the economy is going to be in the future, retracted by 0.7% in March after falling in January and February. So what that's telling you is that there's weakness in the economy being predicted for the future. The 2 biggest factors that were negative, one of them was consumer sentiment, right? That was the biggest factor. That's a problem because the United States is a consumer economy. So if the consumers are negative, it can become a self-fulfilling prophecy, right? People get nervous, so they don't spend. The not spending will cause a recession. Okay, that's the way our economy is built. The second thing, however, in the leading indicators that I saw that concerned me was that manufacturers were not seeing orders for the future coming in, which is telling you that businesses are not ordering from businesses because they're nervous, right? National mortgage originations fell by 7% in the first quarter over the previous year. That tells you that there's a lot of things there, right? Rates are high, there's not a lot of inventory, but also consumers are saying, maybe I won't move into that bigger house. Maybe I'll just wait. And as you all know, people spend the most money when they move into that house, right? Oh, I need a new fridge, and well, that kitchen doesn't really look right. And right, so if people are doing less of that, that's less money flowing through the economy. Interest rates are very flat right now, right? A 3-year T-bill and a 10-year T-bill, there's only about 25 basis points difference. As a banker, that makes me want to cry because I can't make money that way, but that's a reality. That's a little bit of concern. That tells you that there's uncertainty as to where the economy is going in the marketplace. And again, the stock market whipsawing, it's not the issue of it whipsawing, right? That's going to happen, and these guys are right about long-term, the stock market always does well. So I don't disagree with that. My concern is that as a consumer, if I see my 401k do this, I may spend less. I may say, you know what? I'm a little nervous. I'm not going to buy that extra whatever. I'm not going to put the addition on the house. I'm not going to get a new car. Maybe I'll drive this car for another year or two till I see what prices are going to look like and I have some certainty. So that's my biggest concern as someone, you know, who considers himself a household economist, is what are the decisions that the average local person is going to do? So part of what I've been doing over the last month or so is reaching out to my small business customers and talking, small manufacturers, small folks in retail. And for the most part, the manufacturers are saying, yeah, you know what, I'm going to hold off on that machine. I'm not going to buy that next piece of equipment. I'm not going to hire that next body. So that's got me concerned. Anytime the current regime, you know, says something about the federal chairman is concerning to me because, again, I'm a banker and those two things should live apart from each other. Politics and who's running the Fed should really not talk. It's always been my belief. So as we look at what's happening, as I talk to my customers, they're saying, what should I do, right? So the best advice that I can give folks from a kind of how you prepare yourself if bad times are coming is, if you have a home and there's equity in it, get a line of credit now. Because one of the things that happens anytime that there's a recession is banks start to tighten up their lending criteria. So if you have equity, you just want to be safe in the future, I'm not telling you to spend your line of credit, but have it available in case you need it for the future, right? Now is the time to do it. You know, banks only lend money when you don't need it. So make sure that you're ahead of the curve. Yes, I'm that kind of banker where I just tell you the truth, right? If you're a business, get a line of credit in order for your business, whether it's from a supplier or your local bank. I am recommending that folks go to local banks, not just mine. There's a lot of good local banks still in Connecticut. That's one of the things that makes Connecticut a very lucky state, right? You've got your Union and Danbury, Guilford Savings, Thomaston, Milford Bank, Fairfield County Bank. We still have community banks. Huh?
New Haven Bank.
New Haven Bank, nice folks. Yeah, you know, that just, you know, that act differently from the big banks. Make sure that you're looking at your supply chain lines. Okay, I'll give you an example of a gentleman I was talking to on a call the other day. He makes coffee, right? He imports beans from Honduras. There's been a 10% tariff put on those beans. Doesn't make a lick of sense. This is a political statement because we can't grow beans in this country. So why would we tariff a product that we can't actually grow in the US? Doesn't make sense, but it's happened. So when his concern is, it's not only that he's going to pay 10% more for the beans, but he has a seasonal line of credit. So when he buys his beans, he buys them on credit. and then he pays the bank back. Well, now he's gonna have to pay the bank more because his cost just went up more than 10%, because the interest is now has to be paid on that. But in addition to that, he has to look at his packaging. He buys from American companies, but they source some of their stuff from other countries. So the cost of his packaging is going to go up, right? So at the end of the day, his price is not just going up by 10%. It's going to be somewhere in the neighborhood of 10 to 15%. Okay, so look at your supply chains and what that is going to look like at every minor level that you can. Make sure that your supply chain is going to be able to handle choke points, right? There was a story in the news the last couple of days that Walmart, Target, Costco, met with the administration and said, you're killing us and you're going to have empty shelves if we don't do something. So I think that has softened some of the rhetoric over the last day or so, that we got to get some sort of deal done, because there's no reason the shelves should be empty, right? The average American is not going to tolerate empty shelves. It's not a pandemic. What is your price flexibility, right? If you have price increases, how much are you willing to eat versus pass on to your customers? And along with that, identify who your best customers are, right? Who are the ones that actually make you profit? Volume, as you all know, doesn't always mean profit. You can have a lot of customers, but if they're buying your least expensive product and there's not a lot of lead room in it, you didn't do well, right? So who are your best customers? What are you willing to do for them on pricing versus what you might do for others? So those are the conversations I'm having with our business customers and saying, look, these are the things you should think about. We're happy to talk it through with you. But I have concerns because, this bean manufacturer that we're talking to, or coffee seller, he goes, look, I sell coffee. No one's going to stop buying coffee. That's the reality, right? Who's going to not get their morning mocha? Not going to happen. Even if it goes up $1, $1.50. But let's say it goes up $2. 7 days a week, that's $14. That's almost $60 a month. That's $60 a month less that person is going to spend on something else, right? So that is my concern, is that whatever long-term happens with tariffs, and again, I do believe the economy is going to be strong long-term, because the one thing America is good about is we got a lot of people who like to spend money, is that in the short term, we're going to be choking off consumer spending, which will lead to a slowdown. So that's my good news.
Thank you. Thank you.
Yeah, I'm just a ray of sunshine.
Have
I
one
appreciate it.
person talk to me, I can help them with US packaging.
Excellent.
And now we've got Daniel. Would you mind giving us a little bit from the manufacturer?
Sure. So my name is Dan Michaud. I'm Director of Manufacturing at Bead Electronics. I've only been at Bead now since September of 24. I'm happy to be there for a lot of reasons, but I'm especially happy to be there currently now, because where I worked before in Cheshire, the company that I worked at, we did a lot of importing. Probably 95% of our goods were imports. So obviously when we went through the tariff phase a few years back, it was a huge impact. And I actually just had dinner with the CEO of there just a couple nights ago, and he's really struggling with these tariffs because it's spread out to other countries. We diverted a lot of our goods back then from China to India, and now there's impacts there as well. So with Bead, what's great about Bead is we've been in Connecticut for 111 years now. So we do all manufacturing here in Connecticut. We import very little. Our raw materials, there's very little import. So from that side of it, we're not really getting impacted that much. The one big impact is we've been working on a next gen machine for about 6 years, a really long time, and honestly too long. And we pulled the trigger to get that on the boat and get it over. And then they got hit with the 20% tariff. So that was going to be roughly an additional $200,000 to the cost of that piece of equipment. So thankfully we kind of took a breath, and I think that's a big part of right now. Everybody's got to take a breath, pause a little bit, and have some thought. And we worked with our supply partner on that machine, and we said, you know what, let's just pause it. Let's see what happens over the next 90 days. And that's when tariff was for the European market. I think it was at 20%. And then it got dialed back. It got dialed back to, I think right now it's at 10%, but we still haven't acted on it yet. So now it's kind of playing a little bit of a waiting game with the supplier and see what they can do for us to, maybe we share some of the existing tariff and so on, but we are monitoring it daily because we don't want to see it uptick again and then have a large exposure. But even at 10% exposure, it's still, almost 100 grand. So it's still a good amount of money. We are starting to see some questions from our customers though, as far as asking us can we reduce some pricing because now they're going to have to pay some tariff importing it into their country. There was just a question today, I believe it was going into China, and they're concerned that I think it's at 140% going into them. So they asked, is there any way that we can reduce our costs? When it comes to cost right now, we're in a position where we're really looking to raise our costs because we've held costs for probably 3 to 4 years. So we've been talking even before tariffs that we really need to increase costs because everything's going up. But then with the tariffs are coming into play, it's kind of sped that up a bit. And the reason for that is because if everybody's going to their customer base and trying to hit them with increased costs because of tariffs and all of that, and we take too much time really figuring out the right price point we want to be at, we're going to be behind the curve, and those companies and businesses aren't going to be able to really accept too much more increase. So when we're going to our customer base and talking about price increase, we're not even talking tariff. It's not tariff related. It's labor. It's cost of doing business, regular raw material increases, and so on. It's not really tariff related to us. There is one product line that's specifically bought in Asia and supplied into us. So that part of the product line we don't produce. So that we might be tariff specific about. And then if tariffs go away or reduce, we could adjust that. But everything else is basically day-to-day normal cost of business increases that we're going to try and pass along and we're going to try and execute on. But as I mentioned, us as a business, the biggest impact was on the machine. Even last go around, they had exclusions for certain things like that. If these tariffs stay in place, I would love to see exclusions entered in here where, if you're buying a piece of equipment that maybe can't get manufactured here in the US because of skill set, technology, whatever it may be, but then yet you're going to produce the product in the US, that should, in my opinion, that shouldn't be at the full tariff rate on normal trade. So that's kind of where we stand.
Does anybody have any questions? I might have one or two if I could ask Matt or Jeff. Would you diversify a little bit more of your investments into some things outside of the US dollar, not necessarily gold? I'm not telling you to do that. I did have a client at one point in time who told me he wanted to buy a backhoe and a lot of copper and just bury it in his backyard. That was his investment plan. I didn't invest it, but diversifying into various currencies or buying some of the larger companies in Europe, some of the larger companies in Japan and things of that nature. I mean, is that something that you would, again, I'm not asking for actual advice here, but
yeah, no, it's a great question. And my answer to that is yes. We believe that you should always have a diversified portfolio. We're never going to, well, I shouldn't say never, but our style is not to invest in something concentrated and hope for the best and just put all our eggs in that one basket. So we believe in diversified portfolios. In regards to equities, we believe you should have global exposure. There will be times where US equities are more attractive and European equities are more attractive. If you look on an absolute basis right now, which we look at equities sometimes, what's called the price to earnings ratio, European equities are technically trading at a lower PE ratio than US equities. And that's always been the case for most of history, but some would argue that is an attractive time to own European equities. There's other things that could make them more attractive as well. A new example is Germany recently issued or is planning to issue a really big bond to expand their infrastructure And they're gonna use that money also to expand their defense, so their military and all of those types of things. That usually sparks it, and it's an attractive time. And what could happen, and there's speculation it could happen, is that more European countries hop on board and start to really inject money into their own countries. As really the world, I hate to say it, but like, as the world really kind of focuses on their own country for the time being with what we've kind of been forced to, to deal with. So yes, I think the answer is yes. I don't know if you want to add anything there.
Just to add, yeah, so I mean, international has done very well so far this year, but the US side has not. So that's why our approach, as Jeff mentioned, is to take a diversified approach. You want exposure to different asset classes, investments by size, small, medium, large, and then by style, value, and growth. So we certainly would agree with diversified approach there.
And by currencies. Okay. And as far as, Jorge, the degree of concern that your customers are having, I mean, is it a variance? Is there people who are extremely?
Yeah, I mean, it is a little bit all over the place, but it's more worry than I've seen in a long time, right? It wipe out the pandemic, right? Because that's a once in 100 years, but it feels like 2008, the level of concern that people have. And I think part of the challenge is you're dealing with, more millennials are in the marketplace, right? They're own their homes, and this is now the fourth once in a lifetime thing they've dealt with.
Yeah.
So all they know is what the hell.
Right.
First it was 2008, and then there was a pandemic, and then there was this, and now this.
Yeah.
So they're expecting the worst. So there's that group. And then, the older folks are kind of like, yeah, it is what it is. But my small business owners are more than anything just being cautious, saying, I don't want to put myself out there. I don't want to risk my business. So I'm just not going to take a chance. I'm going to just stick to my knitting and do that thing, which is probably what makes sense for them. But again, big picture of the economy, it's not a good thing. And then the other thing I will say that I am concerned about that no one's talking about at the moment is the cascading impact in local nonprofits, right?
Yeah.
Because that's not only the economy, but also some of the, the regime's other policies could impact, you take bridges, for example, right? Where 15 to 20% of their budget is federally funded. The Boys and Girls Club, it's 10 to 15% is funded. So what happens as that money dries up and businesses are now tightening their wallets because they're trying to make other decisions? What does that do to our local nonprofits? And, as my friends like to tell me who don't live in Milford, that they say Milford is the nonprofit capital of the world. If you want a nonprofit, you just build one, apparently in Milford. But that's a concern. So that's one of the things in the back of my head that says, all right, how do we make sure we protect our nonprofits? So as I'm talking to those folks, I say to them, same thing, stick to your knitting, see where you might have room to not stretch. Maybe it's not time to add a new program and new staff because, there's some challenges ahead for them as well.
What about your mid-sized customers? Those mid-sized companies, not the GEs of the world, but not the, sorry, Mr. Coffee Beans.
Right.
What are they feeling? What are they saying?
Yeah. So again, for us, we're a small bank. So, I think my biggest customer does somewhere between 20 and 40 million in revenue a year, which is, again, big for small business, but not huge. They're being cautious as well. They're saying, I might not, I'm going to see if I can get another year out of that piece of equipment, right? I'm not going to buy, that new gen machine right now because maybe I can get it cheaper in 6 months or a year. So yeah, they're not hiring as much and they're trying to see, all right, well, can I do without that extra body? And let's leave that position vacant and see if I can do without it. So yeah, we're hearing that as well and they're more concerned because a lot of them do have inputs that are international. I've got a friend who runs a manufacturing company out of Stratford. He and I were talking last night actually, and his company's parent owned by a Japanese company, and so he makes these very intricate sensors that stop super trains, and it's all done in the US. All the staff, everyone they hire, the technology's here, but they get some of their inputs from Japan. And so he's like, how long will the Japanese company want to keep us if they're going to now all of a sudden magically going to have to pay more just to get me the input so I can build what they need? So that's, yeah, they're concerned probably even more because they don't have the local customer to deal with.
Sorry, I'm gonna ask another one. Yeah, about, you're talking about employment and that being a fairly decent number right now.
Yeah.
With what Doge just did and firing all of those workers there, they're not collecting it, because they're getting severance and so they're not on those rolls yet. Do you see that as the start of a wave there, or am I over concerned about that aspect?
Well, it's a great question, and I'll kind of hop on a little bit of what Jorge was saying. Not only will it come from there, but it'll also come from companies who are thinking about hiring people that are gonna hold off because they don't know what the future looks like. They don't know what their demand is going to look like. So I think you're gonna get, unfortunately, a big part of uncertainty is these huge capital decisions that firms make in hiring people. And yes, will those cuts eventually hit the unemployment? In all likelihood, yes, right? Because, not every one of those people is going to find a job right away after their severance runs out. So, as long as we have more uncertainty, I think that's going to, it will likely tick up, in my opinion. So again, and when we think about these things, we look at the labor markets and we think about inflation. That's exactly what our Federal Reserve's job is to make sure that we have gainful employment and that prices don't get out of control. So, we've seen the inflation, we've seen that part, and tariffs can increase inflation in that regard. We don't know for how much or how long, but if employment starts to go, then the Fed could step in and cut rates. Right now, if you look at what we look at futures contracts and expectations, and the market right now is expecting 3 rate cuts by the end of 2025. Now, with the craziness that's been going on over the last month, that's changed so many times. Like one day I'll look and it's 1 cut, 2 cuts, 3 cuts, but currently we're seeing 3 cuts is what the market's expecting.
And my concern there, and I hope so, is you might put the Fed in a strange situation where inflation is hot because of tariffs, but unemployment is creeping up, and that's the worst case scenario for the Fed. Because how do they balance those two things at the same time? And well, you can, but that's how we got that's how we got the high inflation of 2 years ago, is because we were just printing money.
Okay, well, thank you. I feel better. I do, actually. It's good to know that we're all in the same unfamiliar boat and we're gonna get through it together, I think. And small businesses do have to get together to try and make sure that we're gonna be there on the other side, because it is America and we can get better.
And here's a half a joke, right? Like liquor stocks have gone down the last couple years because people are buying less liquor.
Okay.
This might be a good time to buy liquor stocks because you never know what's coming.
Diageo might want to
They might be doing all right in about 6 months.
probably weed stocks too, right?
Yeah.
So, but anyway, thank you so much for coming. Thank you to all of my panel here. I think we're doing a great job. We can hit end. Thank you very much, Daniel. Great job. Appreciate you and all the people who are watching. And we will put this on YouTube. So.
Thank you. Bye.
Bye.